Hello guys, welcome back to our YouTube channel Kelezales Tabza Tabsoranzi. So today guys, we are going to take a look at year-ended adjustment, whereby we will be taking a look at our consumable stores on hand. So we need to find out what is consumable stores on hand. When a business buys packing material, stationery, and consumables, they are treated as expenses. So look, now guys, we know that packing material, stationery, and consumables, they are part of consumable stores on hand, and whenever they are treated, they need to be treated as what? As expenses. According to the accrual principle, only the value of stationery, packing materials, and consumables, those three expenses used during the year, may be shown as expenses when calculating the net profit at the end of our financial year. At the end of the financial year, the trial balance will indicate total expenditure for the financial year for stationery, packing material, and consumables. At the end of the financial period, when the stock count is conducted, again we see our keywords. When the stock count is conducted, the consumables that have not used, meaning that have not been used, cannot be shown as expenditure in this financial year. It will only be used in the next financial year. And then the consumables, stationery, and packing materials not used, it's called consumable stores on hand. So we know that consumables, stationery, and packing materials that have not been used, then they are called consumable stores on hand. It means that consumable stores on hand, which was part of expenses, will now be converted to assets, meaning that we know consumables, stationery, and packing materials not used will now be called consumable stores on hand, meaning they are no longer part of expenses, but they will be converted to an asset. So guys, let's take a look at the activity that is related to consumable stores on hand. So let's take a look at activity 3. I have activity 3 here with me, and I also have our answer sheet. So required: record the following transactions in the general ledger, and also indicate the effect on the accounting equation. Always remember guys, whenever we do year-ended adjustment, we need to have our first step clear, which is pre-adjustment trial balance, which is step 1, whereby we are going to have opening balances for a specific account, and then we have our trading stock, we have our stationery, we have our packing material, and then it says extract from the pre-adjustment trial balance on the 28th February, meaning we'll always have our timeline, and then our financial year ends when? February, meaning it started when? March, and then it's March, April, May, June, July, August, September, October, November, December, as well as January. And then our financial year ended when? 2021 February, meaning it started when? 2020 March. And then at the beginning of our financial year, which is March, we have opening balances for trading stock, stationery, and packing material. Meaning, let's first record our opening balances. For stationery, we have 63,800. And then we are going to write March 2020 on the first. We had balance brought down of 63,800 for trading stock. And then we also have stationery. We also have stationery of 2,500. And then let's record stationery. And then guys, always know that you classify your accounts, and then stationery is classified as an asset, increases under what? The debit side, decreases under what? The credit side. And also stationery needs to be classified as what? As owner's equity, and it's an expense account, meaning all expenses will increase under the debit side while they decrease under your what? Your credit side. And then our opening balance for stationery will write 1st March 2020. The 1st of March 2020, we had an opening balance, which is balance brought down of how much? 2,500. And then we have packing material. And then packing material, it's an owner's equity, it's an expense account, which increases under your debit side, decreases under your what? Your credit side. And then March 2020, the first, we had the opening balance, which is balance brought down of how much? 1,400. And then we have another account for consumable stores on hand and trading stock deficit, meaning these two, based on our pre-adjustment trial balance, they do not have opening balances. And then now we can continue to our step 2. And then we have adjustment, which is what? Step 2. And then it reads as follows. It says, no entry has been made for an invoice, meaning it's an invoice. So now we have a source document, which is an invoice. So let's find out invoice. What happened with an invoice? Invoice received, meaning we got an invoice from another company or another supplier or another business, meaning that we were buying something on credit. So it was received from Pagati Transporters 180 for the transport of what? Goods purchase, meaning it's what we purchased, goods and services, then it's our trading stock. It needs to be what? Treated as a trading stock. And then we are going to record this transaction. Whenever we are buying trading stock, then trading stock will increase in the what? In the debit side. And then we'll write that we have 180 rands, and then it was creditors control, and then the reference will be what? CJ, creditors journal of 108. We purchased stock, and then we paid and then there was a delivery of 108. And then we continue with our transaction. So since now we have recorded this transaction, then we are moving to transaction number 2. And then it says transaction number 2, no entries were made for stock sold on credit for 6,000, and then the markup on cost is 50%, meaning we sold trading stock of 6,000, meaning 6,000 it's our what? Our selling price. And I told you guys, whenever you are dealing with adjustment or a trading stock, then we always use what you call cost of sales. We don't record the selling price, but we record what? The cost of the product. And then we have been provided with the markup percentage, and then we are going to use our method, which is what? The unknown method or the known method. And then what we have our selling price of 6,000, which is our what? It's our selling price. This is what we have. And then X is what we don't have, which is our what? Our cost of sales. But now what we have, again, we have percentages, and then cost of sales, as I told you guys, it will always be 100%, and then selling price will be what? The 100% plus the markup percentage, and they gave us the markup percentage of 50%, meaning it's 100 plus 50%. Then our selling price is 150%. So now guys, let's calculate. Then we are going to say that what we have the selling price of 6,000, and then multiply by what we are looking for. We are looking for cost of sales, and it's equals to what percentage? 100%. Multiply by 100%, divided by what we have what? We have the selling price of how much? 6,000, and then at what percentage? 150, and then 100 divided by 150. 6,000 multiplied by 100 divided by 150, and then your cost of sales will be, it will be 4,000, and then we need to record our 4,000 since we are selling. And guys, always be able to think out of the box. Whenever you sell goods and services, now you are selling your trading stock. Now what will happen to your trading stock? Your trading stock will decrease because of now the product is going out of the business. The product is going out of the business, meaning our assets will do what? Will decrease. And then under which side? Under the credit side. And then we are going to record it. The trading stock, it's leaving the what? The business. But we sold on what? On credit. Then we have a what? Debtors control, which is what? DG. Then we are selling our goods and services on what? On cost. And then at some cases, as I told you, that always use cost of sales. And then rather than writing a debtor, but we can what? We can write cost of sales, and then saying that our trading stock is decreasing. And then we'll say, let me change a pen. And then we'll say what? Cost of sales, and then the reference, is what? It's DJ, meaning our trading stock left the business, but it was bought on what? On credit. DJ. For how much? For 4,000. And then guys, we continue to our third transaction, and then it says, after taking above into account a trading stock surplus of 1,800. So now we have a surplus. As we spoke, that surplus is an income to us, meaning we have more trading stock in the business. And then of 1,800 was detected as per stock count on the 28th February, meaning at the end of our financial year we discovered that we had a surplus of 1,800. Then we need to record it, meaning we have more stock than we have expected. Of how much? Of 1,800. And then it's what? It's a surplus. Stock surplus. And then it's going to go to our general journal. It's GG. And then we since we have a trading stock surplus of 1,800, then guys, they have provided us with a trading stock surplus account. And then meaning one account is debited, meaning another account must be what? Credited. And then our trading stock surplus, we know that it's owner's equity and what? An income account, meaning all the incomes will increase under the credit side while they decrease under what? The debit side. And then one account is credited, meaning our trading stock surplus must be what? Must be credited. And then we are going to write trading stock, and then it's general journal GG of how much? 1,800. And then guys, we continue with our transactions. And then number 4, it says the physical count showed packing material of 400. It showed the packing material of 400, the physical stock count, meaning the stock at the end of the year. What are we left with? So we found out that the packing materials that were left in the business is 400. And then guys, in going back to the information that we already have, we know that packing materials that were not used, then they will be what? Converted to what? To an asset, which will be what? Will be which in which they will be called consumable stores on hand, meaning now we are no longer having we are no longer having an expense under packing material, but we have what? Consumables stores on hand, which is now going to be an what? An asset, and then it's going to be recorded under GJ of how much? Of 400. And then we continue with our what? Our transaction. And then number 5, stationery of 1,900 was used during the year. And then guys, this transaction tells us that stationery of 1,900 was used, and anything that we used during the year then will be referred as what? As expenses. So in this case, stationery of 1,900 was what? Was used. And as the information that we have, this 1,900, then it will be what? An expenditure whenever we draw up a financial statement at the end of our financial year, meaning that stationery that was used, it's how much? Under credit side, it will be 1,900, and then it's going to go for our profit or loss account, so that we can include it whenever we draw up a what? A financial statement. And then guys, in this case, we have made it, we finished with our adjustment. And then now let's close off our accounts as required always. So we are going to what? To trading stock. So which side is the bigger side under trading stock? And then our bigger side is the what? Is the debit side. And then we are going to say 63,000 800 plus 180 plus 1800, then it's bigger with how much, which with 65,780, and then what you did on your left must be made on your right, 65,780. And then guys, in meaning there is a shortage in our credit side, and then guys and then there's a shortage in our credit side, and then we have cost of sales. Then we are going to write what? Balance carried down. How much is the shortage? It's 61,780, meaning the trading stock that we are left in the business at the end of the financial year, it's how much? It's 61,780. Then guys, in this case we can see that the opening stock that we had was 63,800, and then we bought more for 180 rand, and then we detected that we had a surplus of how much? 1,800, and then we are closing with this. And then out of all the trading stock that we have in the business, we only sold trading stock that is worth only 4,000, and then at the end of the financial year we find out that we still have more trading stock, and then we are going to write balance at the end, which is balance brought down, and then of how much? 61,780 at the end of our financial year, which is February 2021, the 28th of February. And then same thing, 28 February 2021, we have balance brought down of 61,780. And then now we are moving to another account, which is what? Which is packing material. Same thing, we are looking for the bigger side, and then we find out that the bigger side is under your what? Your debit side, and then your credit side is less. And then we have 1,400, and then what you did on your left must be made on your right, 1,400. And then what is the difference between the two? It's 1,000. 1,400 minus 400, it's 1,000. And then meaning what is left is what is the used. So we used 1,000 in our financial year of packing material. Then it will be what? Profit and loss. Always using our information that whatever that was used in the business, it will be what? It will be your expenditure, and then whatever that was not used in the business as an expense, then it will be converted to what? To an asset. And then guys, we are moving to another account, which is what? Stationary. Then we need to close stationary. So in this case, there's a difference between these two accounts. You see, we started first, we were given the information for packing material as what? As consumable stores on hand. And then in this case, we are able to see that they gave us the what they used, and the used was already recorded as profit and loss, meaning now we are left with what? Consumable stores on hand. But first we need to what? To look for the bigger side, and then the bigger side under stationary is the credit side with how much? 2,500. And then another what you did on your left must be made on your right, 2,500. And then 2,500 subtract 1,900, and then we find out that stationary left at the end of the financial year is how much? It's 600. And then anything that is left, we call it what? Consumables stores on hand, and then it's going to go to our general journal. And then guys, and that's how we close off our stationer. And then guys, always remembering that whatever you do on the credit side must also appear under your what? Your debit side. And then since packing materials, we have consumable stores on hand, now we need to transfer them, convert them from being an asset to being what? from being what an expenses to be what to be an asset. So we have consumable stores of 400 as packing material. One account credited, meaning another account must be debited. And then now we know that consumable stores on hand, it's an asset. And then all assets will increase under debit side while they decrease under what credit side. And then we are going to have what packing material. And then it's what it's general of how much of 400 we are converting it. And then same thing when it comes to stationery, we have consumable stores, which is how much 600, and then it's credited, meaning it must be debited. We are having more assets in the business. And then we have what stationery general of how much of 600. And then we are closing off our consumable stores on hand account, looking for the bigger side. The bigger side is what your debit side. And then 400 plus 600 is how much? It's 1000. What you did on your left must be made on your right. And then what is left under the consumable stores on hand, this thing is an asset, meaning we will close it using what balance carried down. And then we have what balance carried down, how much? 1000 rand. And then once we have balance carried down, then we also need to show what the balance brought down of how much? 1000. And then at the end, our consumable stores on hand on the 28th of Feb 2021, they are 1000. And then we go to our last account, which is what trading stock surplus. And then trading stock surplus, we are going to look at the bigger side. The bigger side is our credit side. And then we are going to write 1800. What you did on your right must be made on your what? On your left. And then we have what? This thing is an owner's equity account. It's an income. Then we are going to close it using what? Profit and loss. Profit and loss. And then it's how much? 1800, when on the 28th of Feb 2021. And then guys, we have closed our ledger accounts. And then now we can continue. And then guys, let's just show the dates. And then profit and loss, we have the what? The 28th Feb 2021. And also our packing materials. And also our packing material. And then we have the what? The 28th of Feb 2021. And then guys, now we can continue with our information and study and make sure that we understand. So guys, thank you so much for being with me in this lesson, and I hope you will get home, or you are at home and you will be practicing this year-ended adjustment. And all the best. Please subscribe, like, and press the notification button so that whenever I upload, then you are notified. So guys, it's a bang.